We need to be careful when using a company's balance sheet to calculate its working capital requirement, given the volatility of the balance sheet components over time. This is particularly true for seasonal businesses.
Let's take the example of a Christmas tree seller that makes most of its sales at Christmas. If it closes its account at the end of September, it will show a catastrophic working capital requirement. At this time of the year, in preparation for the holiday period, its stock will be at its peak, while its customer receivables and its trade payables will be at their lowest, resulting in an extraordinarily high working capital requirement. This type of business would therefore be better closing its accounts at a point in the year when its working capital requirement is particularly low. The working capital requirement is calculated at the balance sheet date and should therefore be compared to the permanent or fixed working capital requirement before being analysed. A financial analyst must always be careful to take the fixed working capital requirement into account. The working capital requirement can be broken down into two elements. Firstly, the structural working capital requirement. This is the fixed requirement which follows a long-term trend. It mainly depends on the company's type of activity. Then we have the cyclical or temporary working capital requirement. These are fluctuations reflecting seasonal variations and the volatility of the components of the working capital requirement. This type of working capital requirement can change very quickly in either direction, depending on changes in the economic environment in which the business operates.
So the working capital requirement changes over time, both by following an underlying trend and by fluctuating during the year. The working capital requirement will vary depending on the date on which it is calculated.
A chief executive would therefore want to close the company's accounts at a date when the working capital requirement is at its lowest. According to the equation, net working capital minus the working capital requirement equals the cash position. So if the working capital requirement is lower, the cash position will be higher. As the cash position is a solvency and liquidity indicator, the chief executive will want to prepare the accounts at a time when they give the best possible picture of the financial health of the business. A ski manufacturer, for example, will want to close its accounts at the end of the season, at the end of April, for instance, when the stock of finished goods has been reduced, the majority of customer receivables from sales in previous months have been banked, and trade payables relating to the next season's manufacturing are at their highest. That will mean that the working capital requirement is at its lowest and the cash position at its highest.
We note that the chief executive could voluntarily decide to reduce stocks at the end of the accounting year, not necessarily to take advantage of seasonal activity or an advantageous balance sheet date. This would be classic balance sheet window dressing.
What is the impact on a company's working capital requirement of an increase in this ratio? Does the working capital requirement increase? Does it decrease? Or does it have no impact?